This budget is a growth-oriented budget. It's a well-balanced, practical budget. It gives a push to the investment in the economy while targeting fiscal prudence. The fiscal deficit and the borrowing numbers are in line with the market expectations. In fact, bond yields had gone up prior to the budget as there was some nervousness or anxiety in the market over the borrowing numbers. But post the budget, the bond yields across the curve have fallen by almost 10 basis points. So all in all, we think the budget has been pretty good in line with the expectations of the bond markets. Though the next year's borrowing numbers are slightly higher than this year's numbers, but we expect the borrowing to sail through quite smoothly. We are constructive on the 3 to 5 year segment of the curve, as we believe that RBI will pause after the expected 25 basis hike in next week's monetary policy. Though the domestic bond markets will be influenced by the actions taken by the global central banks, and in particular, the terminal US Fed fund rate will have a important bearing or will be an important variable for the domestic bond markets to watch out for. All in all, we expect the benchmark 10-year bond yield to trade in a range of 710 to 740 over the next couple of months. PGIM India Mutual Fund's fixed income investment philosophy is to protect capital and grow income. Debt investors do not like surprises and volatility, and our investment philosophy focuses on that very fact by ensuring downside protection at all times. We focus on fundamental analysis and follow a relative value framework for asset allocation and security selection while emphasizing diversification and risk management. We have a robust system of internal credit ratings which is based on an in-house model of financial ratios. We look to generate alpha through our duration calls while being conservative on credit selection, where we ensure downside protection at all times. The fund will track the CRISIL IBX Gilt Index 2028, and we believe it's an opportune time to invest into fixed income as yields are close to peaking out, with the MPC set to pause after the expected 25 basis increase in the repo rate next week. We think that the 3 to 5 year segment of the yield curve will do well on a carry and roll down basis, as the current yields are above the present and expected inflation levels, offering a positive real yield to the investors. As the portfolio will consist of 100% sovereign securities, it is a high quality portfolio from a credit risk perspective, and if the investors come in with a 3-year and above investment horizon, the interest rate risk also gets mitigated to a large extent. It is a passive roll down strategy and offers a very good investment opportunity for investors to ride the current interest rate cycle. The yield curve is flat, which means that market is expecting inflation to fall going forward. Globally and locally, inflation has already cooled, and we believe that rates and yields are close to peaking out. Spreads of SDLs and AAA rated securities over G-Secs are much below their median, which favors G-Secs on a relative basis. And we believe that the current yields offer an attractive investment opportunity from a risk-reward perspective. The fund offers tax efficiency with indexation benefits, flexibility to withdraw without any exit route at any point of time, relative safety of government securities, and a highly liquid portfolio. Investors having an investment horizon of 3 to 5 years can invest in this fund. Investors looking to lock in their investment at the current yield levels and preferring a passive strategy can look to invest in this fund, as the fund is going to follow a passive roll down investment strategy.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.